Hello everybody and welcome back to the channel here at Prijs Novice. In today's episode we are going to take a look at my own personal portfolio. Now I would just like to preface this. I'm not a financial planner, I don't work in a bank, I have no professional knowledge of investments or the banking system in general. However, what I do have is an interest, and I started doing this a year ago and I figured I could share my journey with you guys, the viewers. Also, I would like to mention that I'm not going to show the actual funds that I use because they might depend a bit on your location, what type of account you have, so I figured I would just go by the indices or the major markets that I'm trying to track and the corresponding weighting I have within my portfolio to make it more balanced. So stay tuned, guys. So if we take a look at the first position here, you will see emerging markets, large cap. Basically what's happening or what's been going on, I'm not going to make big whole history lesson here, but the BRICS, the BRICS, Brazil, Russia, India, China and South Africa have been typically quite large economies, especially India and China. But what happened to them? Well, a couple of hundred years ago, we had European colonialism. And they basically went in and pillaged all the natural resources and took everything away from them, and then we had slavery and so on, a black period in the history. However, these economies are now coming back, and they are coming back strongly. Just look at China over the last 15 years, enormous growth and still potential for the future. So that's why the large cap emerging markets make up 20% of my portfolio. And next up is the global large cap companies, going by valuations and the capitalization basically. And this particular fund that I'm using is an index fund, so it's very cheap. It contains, I believe, close to 1900 of the world's largest companies. Starting from the top, you have the Apples, the Amazons, who by the way recently passed Google. And then I'm not entirely sure. Yeah, Facebook probably. In any case, 1900 of the world's largest companies. So whatever happens when you look at the MSCI World Total Net Return Index, that's what's going on in the fund that I own. And then guys, we have the global small cap. Now why do I make an equal weighting between the large cap and the small cap? The small cap typically sees more growth, whereas the large cap typically sees more value investing, dividends and so on. Now most of the funds that I use personally, they have a plan where if the company within that fund is owning within it pays a dividend, that dividend goes to automatically buying me more shares of that fund instead of paying the money out because of tax reasons basically. Again, the small caps, they typically see a bit more growth, but they are also a more risky investment. Typically speaking, the small caps outgrow the larger cap indexes. And this is true for the global markets as well. You can look up the MSCI World Small Cap. So that's the index that I'm following with this particular fund. And then global real estate and utility. If I were to comprehensively make an argument for why I own this, it would be that it is not necessarily a correlating asset. Now keep in mind, these are still stocks in companies that deal with real estate and utilities all around the world. Even though you say, oh, you shouldn't own only stocks, you should own bonds, cash or real estate. Real estate stocks, in my opinion, are a part of owning real estate. And so the real estate and utility part plays a big role. It is sort of a hedge against the inflation. Owning your own property if we have huge inflation is typically speaking a good idea. It's a real hard asset. And if you think about it, prices of houses might go up and down, or the price of electricity as in, utility or gas or such. But when it comes down to it, people still need a place to live, they still need their electricity, and they might need gas to cook their food. And I'm using it as a way to balance my portfolio a little bit, a bit of a safety, but still not completely safe. Nothing is. And then we go into the developed markets and government bonds. 10% of my portfolio is in developed market government bonds. As of this very moment, that might not be a great idea because The interest levels that we're seeing now around the world, here in Sweden and elsewhere, central banks around the world are going eventually have to be forced to increase interest rates. And as they do, the value of a fund tracking government bonds will go down. Because now you can buy new bonds that pay more of an interest. Why would I own the old? And you have to consider that government bonds typically have a very, very long length of period. It might be 10, 15, 20, 30 years. Next up is developed markets. Again, the developed markets of the world, but this time it's about commodities. So we have oil, electricity, gas, uranium, gold, silver, copper, aluminum, depending on where you are. These are definitely uncorrelated assets to stocks. Bonds are uncorrelated as well, but especially commodities. It's often said that when there is trouble on the horizon, or when people are a bit scared of the stock market, they flee to gold. And the particular fund that I own is not actively managed, so it's not trying to pick the best commodity at that particular moment. Instead, it takes some of the 15 most traded commodities in equal weighting. So again, that's a way that I'm hedging my bets a little bit. Now, as I am from Sweden, obviously I have some exposure to Sweden, not simply by living here, by working here, by having a house here, but also in my portfolio. Corporate bonds. Now, Swedish corporate bonds at the moment, I could expect around 3 to 5% of interest per year, and these are short duration interest rates. Corporations that pay out a bond are typically a bit more risky than government bonds, because the governments, they bring in taxes. There is basically, or worst comes to shove, they could print money to pay out, but then we will end up in a different situation, and we don't want that either. Corporate bonds are a bit less safe than government bonds, but they pay a bit of a higher yield. Again, Sweden, large cap stocks. Now, these are the major companies in Sweden: Volvo, ABB, quite big companies. And these are safer, but they don't see a lot of growth. And keep in mind that Sweden, if you look at a global scale, is still considered a risky market because it's very small. We are heavily dependent on exports and imports. Finally, Sweden, small cap stocks. Again, as it is with the global version, I am looking for some Swedish small companies that have a potential for larger growth over the long term. I am looking for emerging markets, small cap, but the ones that I have found already are very expensive, and their performance is very, very similar to the large cap emerging market index funds. So as of yet, I don't see a reason to invest in those. I don't want to pay more money to get the exact same performance as I already have with the large cap emerging market index. So if we take a look at the bottom here, you see around 60% of my portfolio is in stocks, 20% are in bonds, 10% in commodities, and 10% in real estate or utility. The cash position is not a part of my investment. I just took the amount of money that I have liquid in cash and divided up by the amount that I have in my investments, and this is the figure I got, around 3.9%. A case can be made that at the current moment one should be higher in cash because the markets are typically overvalued. Even the indices themselves are overvalued all around the world. So you might want to consider having a cash position. I think Warren Buffett at the moment is at 45 or 50% cash, and he's the greatest investor the world has ever seen. So, you know, you could take a clue from him. I myself, I don't really intend to increasing my cash position at the moment. Remember, if there is a huge market correction or the stocks start to turn down again, what I do is I could trade either my bonds or my commodity positions, because chances are they will increase slightly if stocks go down. I could trade those for more stocks. So we'll see what happens. But for the moment, and for the foreseeable future, at least 2 or 3 years out, this is my target allocation. Consider your own positions. It's all about risk management when it comes down to it. What sort of risks are you taking? A typical 60-40 portfolio would be 60% stocks and 40% bonds. But I also have the utilities, real estate, and of course the commodities mixed in there. Even though my cash position is a bit small, no matter what happens in the markets, some part of my portfolio will increase while others go down, and I can do some rebalancing. So that's it for today's episode. As always, leave a comment down below. What are your positions? What does your portfolio composition look like as of right now? How many % do you have in cash? Which is a very typical question you will see all over YouTube at this particular moment. The stock markets being at the level where they are, close to all-time highs. We're seeing huge volatilities over these few last weeks. Cash position, your percentages, your exposure. Let us know in the comments down below. Leave a like and subscribe. Take care, guys. See you around.